Welcome back, everybody, and we're joined as ever by Alex Jamieson from AJ Financial Services. But I've got to tell you, this is different. I'm not allowed in the studio. He's not allowed in the studio, so we're doing this via Skype. I'm at home, and he's at work. So let's hope that this works out. Alex, it's great to see you. Can we start off by just talking about the gold and silver bullion? There seems to be a run on that at the moment. What are your comments on that segment?
Yeah, Greg, if we pull up this chart, we've spoken about this chart before. This is the sort of, I call it the economic clock of the herd. And when we look at recession, what do we see as the asset class? It's gold. The GFC was no different. This time's no different as well. And essentially, usually with quantitative easing, when the government sort of prints a whole lot of money, they're trying to do a couple of things. The first thing they're trying to do is flatten the yield curve, so interest rates are a bit cheaper for borrowers. The second thing they're trying to do, though, is actually, they won't want to say this, but they're trying to devalue their currency a little bit, makes them a little bit more competitive in the international marketplace as well. And that's really what we're sort of seeing at the moment as well too. The US dollar has been depreciating, but certainly the gold run started a little later than I would have expected. I thought it would have kicked off a little bit earlier, but we're pleased to see it there. In terms of expectations, look, we've got some price targets that we've sort of looked at. We sort of feel that it's probably got another 11 to 16% higher from where we are at the moment, and silver usually sort of runs along with gold, which it's doing at the moment. We sort of feel somewhere in a mid-40s price target per ounce. These are USD numbers, is where we expect it to head. We sort of feel we're sort of late-ish in this cycle now, so for any of those investors that are sort of going to get caught up with gold's going to go to 25,000 or anything of that nature, you're probably a little bit late in that cycle. Silver in particular has a nasty history of dropping incredibly quickly, so it's one you want to be keeping a pretty close eye on as we go along.
Now, I know you've been an expert in gold over past years. Do you have a preference still of gold over silver?
Look, this time round, actually, we've played it a little bit differently. In the GFC, we went for the physical bullion, and we probably went 70-30 with the gold-silver sort of split back then. This time round, we've tackled it actually with the miners. We sort of felt that we left some money on the table a little bit with the gold price appreciation, and so we've gone in, we got set up actually before the sell down sort of occurred with some gold miners that we felt were really well placed to capitalise on it. And really from that side of things, yeah, the miners have done really terrifically well. It's a little bit leveraged on the share price, so the gold miners are different in terms of a different trade, but certainly we've sort of enjoyed that sort of path that they've sort of, and the returns that they've sort of generated for our clients.
When we spoke last time, we talked about how the share market was recovering, yet the economy was still in recession. Do you have any further comments on that?
Yeah, I thought it'd be helpful if I show you this chart here. This was taken from the 1980s, and look, we could pretty much go through most of the US recessions, and I just grabbed this one as sort of a placeholder to sort of highlight it. The grey shade is the US recession. Australia hasn't had that many recessions, so they're sort of not as common from a chart perspective. We're certainly seeing slowing in the business cycle, but in terms of recession, not as often. And what we sort of, you can see in the chart is this is the S&P 500, which is the US market. Is the share market did start recovering before the grey shaded area completed, which is the completion of the recession. And so it's really common, like we could go through every sort of business cycle, and you'll see a similar sort of pattern where the share market is anticipating that recovery and starting to see it. For the propeller heads that are out there, there's a little interesting sort of dot point that says personal income, and that's an interesting sort of one. What the other sort of findings that sort of comes out from the research is basically when personal incomes sort of tick up a little bit in the US, it can be an early sort of flag that the recession is coming to an end. At the moment, we're sort of seeing in the numbers that may be the case. It's a little bit too early to tell. The GFC was actually a lagger, but the other previous sort of recessions, they did find it as a leading indicator as well too.
So does that mean some areas will recover more quickly than others?
I think so. Like there's sort of an assumption that everything moves together in simultaneous, I guess, sort of pattern from a recovery perspective. And what you sort of find is that disjointed. It's sort of like if you sort of think of a young kids doing the cross country race around the oval, you've got the front runners and then the middle of the pack and there's someone at the back that tends to walk, and the economy is pretty similar with that. This chart here sort of shows an expectation around the front leaders and obviously the other areas that are laggers, and an obvious one would be something like travel and tourism for international. You know, there's sort of talks now that could be as late as 2022, 2023, 2024 before we sort of start to get close to sort of the sort of CV19 sort of peaks, whereas something like artificial intelligence that dealing with digitalizing your business is obviously the front runner that's either not affected at all or bouncing back super fast.
Okay, Alex, let's get down to it. We in Australia, in Melbourne, we're in stage 4 lockdown. We have a curfew, which we have never had in the history of our city. So what do you think the impacts will be on this for our economy?
Yeah, I think there's sort of two sort of aspects of it. So I think for a lot of people, this has really rattled them, and rightly so. You could sort of see the nervousness in the share market yesterday. So we're cutting this recording just so people know that the day after those announcements were made. And so I wouldn't have been at all surprised if our market tanked yesterday, and it didn't, which was kind of surprising to it. And today it's rallying. Victoria represents about 25% of GDP, and the analysts are sort of indicating, look, it should shave somewhere between 0.75% up to 1% off the GDP growth sort of numbers, depending on how things sort of progress. In terms of the quarters, so, you know, the June quarter was sort of spoken about that. That one was expected to be about -8. And then the September quarter was sort of posting a number that was positive, about 1.3, 1.4. My expectation is that will be slightly negative now, maybe sub 1, within that sort of range of -1%. But it's not I think people really need to understand is it's not a complete train wreck. You know, there's obviously a whole lot of other states that are doing quite well. There's still risk with second waves and all the rest. I think that probably the area that it's really going to hurt is that small business. And right from day one, we said this is a small business crisis. And I think the second wave pretty much is going to be pretty nasty for most of those small business, and all it's doing is accelerating that digitalization cycle that's going on, and the bigger players as well. So I really feel for the small businesses. I think the unemployment numbers are going to be pretty ugly too in Victoria. They're definitely going to be in a double-digit sort of number, is my expectation. I guess and sorry for dragging this answer a little bit longer, but we also said up front too with the virus that it is a bell curve. So, you know, although it's not a great example, if we go to somewhere like Sweden as a case measure, you know, they didn't go to lockdowns. They went to that other form of herd immunity, and it was very controversial. And they obviously had a lot of deaths and a lot of negative sort of aspects, but they are through that bell curve. So it's not a case of, oh, this is going to go indefinitely. You know, Sweden, I think they're down to case numbers of 25, 45, sort of really, really low numbers. And they got much higher than where Victoria is. So whether the lockdowns work or not, the virus will just eventually run its course as a bell curve, as we're sort of giving people updates as the early part of this, and I don't expect this to be any different.
Where are we at then with the virus and vaccines?
Yeah, so here's really interesting. So there's actually a few front runners, and I'll bring up this chart. So the front runners with the large medical companies, we've got the Oxford study with the AstraZeneca, and they're sort of indicating they'll have early releases around that September, October. You then got the Moderna, and they're sort of talking possibly a December sort of October-December period, and then you've got the Johnson & Johnson. Interestingly, there is, and they're all in phase 3 sort of stages. There's a one actually in Australia, which is the Murdoch University study as well, and that is also in stage 3, I believe, too. So we're sort of sitting here in August. We're a couple of months away from having hopefully some good news on some very early vaccines. I don't believe we'll have access to them. It sort of seems the lion's share has been tied up with the UK and the US, taking most of the stock. Whether we get any or not, we'll have to see. But I'd expect within the first quarter of next year, a lot of that. If anything, it's just going to settle everybody a little bit. Like any sort of early vaccine, they won't be incredibly bulletproof, and they'll progress as years goes on. But I think certainly if that AstraZeneca Oxford one, which is the front running one, becomes available in October, that would really help, would be benefit for the broader markets.
Well, finally, Alex, what's the forecast for the government debt?
Yeah, we sort of spoke about that government debt sort of piece and where things were headed as well. And I thought this chart would be pretty helpful just to sort of extrapolate it. There's a few economic theories that are out there. And so one of them sort of, obviously, the old sort of, you shouldn't spend what you don't have. And that's sort of what we call the gold standard, where basically, government spending should be constrained, and obviously the goal sort of prohibits them going on to do crazy things, and essentially with that sort of aspect, it sort of hopefully avoids what they call hyperinflation. The other area of spending is, look, the government should stimulate if it's sensible, and the third one is, this is all nonsense. The government can print their own money. Within certain proximity, they should just continue to print that money, and the realities are it never needs to be paid back because they own the printing machine. And so it depends on where you sit on the spectrum, but we can sort of see here, the forecasts are probably putting us somewhere around 50% debt to GDP. As I sort of said, Japan's sort of the front runner. They're well over 200% of debt to GDP. And at this stage, interest rates are nowhere to be seen. So we feel pretty confident, even with this extra lockdown measure, even though the government's going to have to borrow a hell of a lot more money to bail out Victoria, whether on a state basis or a federal basis, it should be fine. I think the challenges, though, the Victorian government, their borrowing levels are expected to go from about 65% debt to GDP up to over 100%. And so I guess that's probably the worrying sign, is that they're really sort of leveraging up the state. And you may recall when the Virgin deal sort of was coming up and the Queensland government was sort of having their hand up, the federal government said, a few of the ministers said, Queensland's broke. They sort of made these sort of flippant comments. Victoria is going to be in a challenging sort of situation to, respond to future sort of things like this from a borrowing capacity perspective.
Well, I think you're earning your money. Let me say that. We've been talking with Alex Jamieson from AJ Financial Planning. Mate, you keep well. And before leaving today, I'd like to leave with a little story from the Great Depression. Now, this was about a bloke called Michael Cullen, and he was working for Kroger Grocery and Bakery Company in Illinois, and he was the store manager for 94 of their small stores. Well, he wanted something different, and he sent a 6-page letter to the president of Kroger proposing a new type of food store with a focus on low prices, cash sales, without any delivery service. They had to have large premises, low rents, and ample parking. And he believed that they would get 10 times the volume and profits of the average Kroger store. Would you believe he had no answer to the letter? Not at all. So Michael Cullen resigned. He took his family to Long Island, and he launched his concept there with a thing called King Cullen. He opened his first store on the 30th of August, 1930. Now, this is in the heart of the Great Depression. Would you believe, shortly after opening that first King Cullen store, customers came from 100 miles away because they did their shopping there. It was 10 times larger than the nearest competitor. And would you believe, that was reported within 2 years, they were doing $6 million in sales. Now that equates to $100 million today. Obviously, that concept changed the face of supermarkets as we know it and the way that they did business. I mention it because it's a great reminder that in the face of economic difficulties, which we are facing, we've heard what Alex has said today, there are companies there that are growing and doing so well financially, strongly, despite the challenging landscape. So please don't get caught up too much in the bad news cycle. Keep an eye open for the next concept or investment opportunity, which will change the future direction of the market. From that side, it could be quite exciting. So until next time, be well, please be sane, and look forward to catching you then. Bye-bye.
The advice provided on this program is general advice only. It has been prepared without taking into account your objectives, financial situation, or needs. So before acting on this advice, you should consider the appropriateness of the advice and consult a finance professional. If any products are detailed on this program, you should obtain a product disclosure statement relating to the products and consider its contents before making any decisions. Where quoted, past performance is not indicative of future performance.